Stop scrolling for a moment, not because nothing is happening, but because something irreversible already has. This was supposed to be the quietest stretch of the year. Late December, holiday week, thin volume, empty trading desks. Every year, this is when markets go to sleep. But silver didn't. While most people were offline, while Western screens looked calm and frozen, the silver market crossed a line it has never crossed before. And almost nobody noticed it in real time, because this didn't happen on Twitter. It didn't happen in headlines. It happened where the metal actually moves. Right now, silver in Shanghai is trading around $85 an ounce. At the exact same moment, COMEX in the West is still printing prices near $79, $6. That might sound small if you don't understand commodities, but in a global metal market, a market that is not supposed to have regional price gaps, that spread is not noise. It's a warning flare. This isn't volatility. This isn't retail excitement. And this is not a normal breakout. This is price discovery splitting in half. In a healthy system, gaps like this don't survive. Banks close them. Funds arbitrage them. Metal flows until prices align. But that didn't happen. And when arbitrage stops working, markets don't stabilize. They fracture. That's the first signal professionals watch for. Most people are looking at charts right now and asking one question. Is silver going higher? That's the wrong question. The real question is, who is setting the price now? Because for decades, silver was priced in paper markets. Futures contracts, derivatives, leverage. Physical demand existed, but it stayed in the background. And that balance has just shifted. Shanghai is not a speculative hub. It's not driven by retail traders chasing momentum. Shanghai is where silver is used. Solar panels, electric vehicles, electronics, power infrastructure, data centers. These buyers don't care about sentiment. They don't trade narratives. They don't wait for pullbacks. They take delivery. COMEX, on the other hand, is a paper machine. Over 95% of contracts never result in physical silver changing hands. They settle in cash. That works until someone actually wants the metal. And right now, the physical side is speaking louder than paper ever has. When Shanghai pays $85, that's not an opinion. That's not a forecast. That's availability being priced in real time. When COMEX lags behind at $79, it's not because silver is cheaper in the West. It's because the Western price is still anchored to assumptions. Assumptions that delivery will always be possible, that inventories will always be usable, that paper claims will always be honored. Those assumptions are now under stress. This is not a collapse yet, but it is a signal. Because every time in history physical markets pull away from paper markets, the sequence is the same. First the spread appears, then arbitrage slows, then inventory tightens, then confidence thins. And when confidence thins, price doesn't move politely. It reprices. That's where we are right now, not at the end of the story, but at the exact moment where the system realizes it has a problem. And in the next part, we need to talk about why Shanghai has this power, why this gap is not temporary, and why paper control is slipping faster than most people understand. Stay with me, because once you see the structure behind this move, you'll never look at silver the same way again. To understand why this gap exists, why Shanghai is paying 85 while COMEX is stuck below 80, you need to understand where real power lives in commodity markets. It does not live where the most contracts are traded. It does not live where the benchmark price is published. Power lives in the bottlenecks. And in silver, the bottleneck is not mining. China does not dominate silver because it digs the most out of the ground. In fact, China is only the second largest silver miner globally. China dominates silver because it controls refining and processing. That's the part most people miss. Raw silver coming out of a mine is useless to modern industry. It has to be refined to extremely high purity. It has to be processed at scale. It has to meet industrial specifications for solar, EVs, electronics, and power systems. That infrastructure is expensive. It takes decades to build. And while the West focused on financial markets, derivatives, and leverage, China focused on physical supply chains. Silver mined in Latin America, Africa, and even parts of Asia often passes through Chinese refineries before it ever reaches the global market. That makes China the gatekeeper, and gatekeepers don't need to shout. They just need to adjust flow. That's exactly what's happening now. Starting January 1st, China's new silver export controls come into effect. Notice how quiet this was. No dramatic ban, no emergency press conference, no screaming headlines, just a licensing system. Only refiners producing more than 80 tons per year can export freely. Smaller refiners are effectively shut out. This doesn't stop supply. It redirects it. Silver that would have flowed west now stays east. Domestic Chinese industry gets priority. Exports become selective. And when supply tightens quietly, price reacts loudly. That's why Shanghai moved first. Shanghai clears physical delivery. Industrial buyers there don't care what COMEX prints. They care about whether silver shows up at the factory gate. COMEX doesn't work that way. COMEX is built on leverage, on rolling contracts, on cash settlement. As long as people accept paper instead of metal, it works. But the moment physical demand tightens, paper loses authority. That's what this gap is telling you. This isn't manipulation in the cartoon sense. It's not evil bankers pushing buttons. It's structure. And structure always wins. Because when real buyers show up, buyers who must take delivery, paper prices don't lead, they follow. $85 is not a prediction. It's not excitement. It's not a top. It's the price that clears real demand. 79 on COMEX is the price of belief. Belief that the system still works. Belief that delivery can be managed. Belief that paper claims are safe. Those beliefs are now being tested. And here's the part most people underestimate. When paper markets lose control, they don't lose it gradually. They lose it through forced behavior, margin calls, delivery requests, inventory stress, sudden repricing. That's why this gap matters. Not because it's $6, but because it tells you who is in control now. When we say paper price is breaking, we're not being dramatic. We're being precise. Because a paper market doesn't break when prices fall. It breaks when delivery stops matching promises. And that's exactly what's happening now. COMEX is not a silver warehouse. It's a clearing system. It was designed to manage risk, not to supply industry. More than 95% of silver contracts on COMEX are never settled with metal. They're rolled forward, netted out, closed in cash. That system works beautifully until someone actually asks for silver. Right now, that's happening more often. And when it does, COMEX faces a brutal math problem. Because there are hundreds of millions of ounces worth of paper claims, but only a fraction of that exists as registered silver, metal that can actually be delivered. For years, this imbalance didn't matter. Why? Because nobody pressed the delivery button. But now, physical markets are tight. Shanghai is pulling metal east. Industrial buyers are securing supply aggressively. Export controls are redirecting flow. So when delivery requests rise, banks have two choices. Option 1, deliver metal they don't really have. Option 2, buy metal at any price. Both options are dangerous. Buying pushes price higher. Higher prices trigger margin calls. Margin calls force more buying. That's how control slips away. This is why $79 on COMEX is fragile. It's not supported by metal. It's supported by confidence. Confidence that shorts can roll positions. Confidence that cash settlement will be accepted. Confidence that no one will demand delivery at scale. But confidence is not infinite. Shanghai doesn't run on confidence. It runs on availability. If metal is scarce, price goes up immediately. That's why Shanghai hit 85. Not because traders were excited, because buyers needed silver now. This is where paper price breaks. Not with a crash, not with an announcement, but with a gap that refuses to close. Normally, arbitrage would fix this. Buy at $79 in New York. Ship to Shanghai, sell at $85 free money. But that's not happening. Why? Because arbitrage only works when metal can move. If metal can't move, or doesn't exist where it's priced, arbitrage becomes risk, not profit. That's when markets stop behaving normally. Paper price keeps printing. Physical price keeps rising. Two prices, one asset. That is the definition of a broken market. And here's the most important part. COMEX doesn't need to fail for this to matter. It only needs to lose authority. Once the world stops looking at COMEX as the place where silver is priced, and starts looking at physical exchanges instead, the adjustment becomes unavoidable. Paper doesn't argue with reality. It follows it, late, violently, and reluctantly. So the real question becomes this. If silver has been structurally tight for years, if paper leverage has always been excessive, if physical demand has been growing steadily, why is everything breaking right now? The answer is timing. And timing is everything in markets like this. We are sitting inside the most fragile window of the entire financial calendar. Wall Street calls it Ghost Week, the stretch between Christmas and New Year's. This is when senior traders disappear, risk managers go offline, liquidity providers pull back, large desks flatten exposure. What's left are skeleton crews and algorithms, and here's the mistake most people make. They assume low volume means low risk. It's the opposite. Low volume removes shock absorbers. In a liquid market, big orders get absorbed. In an illiquid market, even small orders cause violent moves. That's why silver didn't grind higher. It jumped. That's why prices gapped instead of consolidating. That's why $79 didn't act like resistance. It acted like paper. Now layer this on top of what's happening physically. Shanghai is already paying $85. Export controls are about to redirect flow on January 1st. Industrial buyers are racing to secure supply before contracts reset. Dealers are pulling inventory because replacement cost is unknown. So while paper markets are thin, physical markets are closing. And that combination is explosive. Think about it. If you're a dealer and you sell silver at $79 today, but, Shanghai is clearing at 85, and, supply is tightening next week, why would you sell? You wouldn't. You freeze inventory. That's exactly what we're seeing. Call for pricing. Out of stock. Temporarily unavailable. Not because demand vanished, because risk did. This is how shortages actually start. Not with panic buying, but with sellers stepping aside. Now look at the banks. They're trapped in the middle. They're short paper silver. They rely on rolling contracts. They rely on liquidity. But during Ghost Week, liquidity disappears. That's when margin calls hurt the most. That's when forced buying happens. That's when one liquidation can move the entire market. And that's what these sudden spikes tell us. This wasn't coordinated buying. This was forced behavior. Somebody had to cover. Somebody ran out of margin. Somebody hit the close everything button. That's why silver moved like it did. Not because the world suddenly woke up, but because the system blinked. And when systems blink during illiquid windows, price discovery doesn't negotiate. It teleports. This is why timing matters more than price right now. Not 80, not 90, not 100. What matters is structure under stress during a liquidity vacuum. Because when markets reopen fully, the damage doesn't reset. It compounds. January brings fresh capital, institutional rebalancing, funds chasing performance. And they won't be buying into a calm market. They'll be buying into a market that already fractured. And once that happens, price doesn't move in lines. It moves in gaps. If you want to stay ahead of moments like this, not react after the damage is done, make sure you're subscribed.